Everyone, and welcome to the August 2026 meeting for Lextran Pension Committee. We'll start the meeting off by starting with the roll call and calling the meeting to order, starting off with the roll call. New member, Mr. Withrow.
Thank you.
Mr. McDonald. Mr. Combs, decided to switch seats today. Ms. Falkenberg. Mr. Watkins.
Right here.
All right, seeing that we do, I apologize. Ms. Gonzalez is absent. Mr. Cigar is also absent. Seeing that we do have a quorum, I will ask everyone to take a second to look at the meeting minutes from May 19th meeting.
Make a motion to approve the minutes.
Have a second?
Second.
Thank you. All right, moving down to the next agenda item is the funding performance report from Mariner Wealth Advisors, Mr. Eric Tile.
Thank you very much. Well, it's certainly has been an interesting time. I will, in my role today, and I apologize, you'll hear my voice the entire time, so we'll try and keep it snappy. We will do our standard review of the overall Mariner position, our organization, and then the details of the plan, as well as a market and economic outlook, review and outlook. So in terms of updates, our continuous update is that Mariner continues to grow. Nationally, that's we're well over $750 billion in assets under management or advisement at this point. But we're very happy that here in the Kentucky market we've eclipsed the $1 billion asset under management or advisement mark. So it's a nice threshold for us as a standalone unit within the Mariner ecosystem. The growth allows us to continue to fund our research and personnel and to deliver the high quality level of service and results that we've done for the last now 20 years, as we just celebrated our 20th anniversary last month. I will skip then ahead without any further updates, just to a review of the investment policy statement before we review overall results for the plan. The investment policy statement summary is on page 7. So our cash target is 5%, our cash range is 0 to 10%. Our bond target is 35% with a range of 20 to 50%. Our stock range or target is 60% with a range of 50 to 80%. The maximum individual position size is 5%. That is a dynamic number, meaning that stocks and bonds move, and so we have to accommodate for that and trim positions down. We'll discuss that in a little bit when we get into individual holdings and results. Maximum international exposure 25%, and maximum investment in small company funds is 10%. That has not been a challenge. The individual bonds must be investment grade, BBB rated or higher, and bonds below investment grade can be held within a mutual fund, but we're not holding any mutual funds, so that's not a challenge for us. We are in a roughly what we consider to be a moderate risk tolerance band, and we use the benchmarks listed as our primary benchmarks to evaluate the overall performance. I will reiterate, as I have the last few meetings, if there's any discussion around or interest in revisiting the investment policy statement, that I'm happy, and as a firm we're happy to contribute to that. That's always available to you, so that does not have to be a static position. It's not a recommendation, just making sure that you're aware that that's something that you can revisit and that we will adjust to as needed. So if I skip then to behind tab 1, unless anybody wants to individually read the entire investment policy statement at this time, we'll get into the overall market backdrop currently. Year to date, and this has been another powerfully positive year for global stocks. The S&P through the end of July was up 10%. annualizing to just under 20% a year. The Dow is right on that same target. The international developed market index is up 12% through the end of July. The Russell 2000, representing primarily small and some of the smaller mid-cap stocks, is up nearly 20%, which is notable. And emerging markets are up 20% through the end of July, which is notable, putting them on track for closer to a 36-38% return for the year on an annualized basis. So no matter where you go, when you look at a 10% return on the S&P 500 through the end of July and realize that is the lagger in global equity, then it's been another very strong year for stocks globally. And as I'll discuss it a little later, the makeup of the returns this year has been different than what we saw in 25, in that you have the 493 non-Mag 7 stocks currently and actually participating along with the international contingent as well. Interest rates are in a new normal range. They have risen. They continue to rise. There's a number of potential drivers for that. But I would look at the shape, what we call the shape of the yield curve. The 2026 shape is different than the 2025 shape in one notable area, the short end of the curve. If you look at the 3-month and 1 year and the inside of 3-year part of the yield curve at the end of 2025, what you'll see is kind of a little Nike swoosh. What that tells you is that that has been artificially manipulated by the Federal Reserve. That is not a naturally occurring event. And so as the Fed has lessened its impact, its active impact in the markets, and allowed the market to set its own, essentially its own short-term rates, then you've seen a more normalization of the curve, where the very lowest, shortest portion of the curve is the lowest yield, and it slopes gently up. That is your standard shape. So you're seeing within that the impact of the continued unwinding of some COVID policies, the continued unwinding of some intervention, and so we see that shape. Now the rise has a lot to do with the fact, the general rise across the board has a lot to do with the fact that the overall debt of the U.S. Government has started to crowd out and is pushing up interest rates within the spectrum. We're demanding more yield for taking on debt. So you're seeing that push up. It's not dramatic. It's certainly not out of historic range. It is certainly out of the range of what we saw maybe 10 years ago, when again everything was suppressed a little bit. So interest rates are a little bit higher, but again, notably not in your money markets right now. Those have actually fallen because again we're not pushing up those short rates, or savings accounts. We're not pushing up those short rates. From a portfolio summary standpoint, the year-to-date performance on the overall portfolio through the end of July was right on 7%. That reflects a 10% return in equities and a just under 1% return in fixed income. The 10-year number has moved to overall just under right at 9.9, so 10%, with the equities driving 13.5 and fixed income driving about 3% of that. Currently, the asset class breakout for the portfolio, we are in a 75-25, so we are within range of the investment policy statement, but we are at the higher end of the equity and lower end of the bond. Again, that's where we've seen returns, so that would be normal in this environment, and why we have ranges in addition to the targets, but we're certainly more equity centric than within the overall mix. The vast majority of that, if you look at the equities, 54% of the overall allocation is in large cap. So we're not diving into the riskier parts of the market. 12% are in international. Core fixed income represents 20% of the overall portfolio, and cash equivalents is almost right on target at 4.6%. The overall plan ending value as of the end of July 31st was $28,762,981. So it has been we continue to see that growth and see that growth exponential within the overall portfolio. If we look on a 2-year basis, 2 years ago, January of 2024, the plan had assets of $20,956,000, growing to the beginning of last year, $23,828,000, to the beginning of this year, $26,861,000, and again, as we stand at the end of July, $28,762,000. On page 22, we have our traditional breakdown, just more representation of understanding of how we are looking at and how we invest the active portion. Roughly 68%, so a little over 2/3 of the equity portfolio is actively managed, meaning our portfolio managers are making fundamental calls on stocks and bonds. They are not strictly following the indices. We believe that a mix of active and passive is the best strategy because it is diversification. Sometimes active outperforms, sometimes passive outperforms. What is statistically proven is that having a combination of the two leads to the best long-term returns. So that is what we do. So currently, 2/3, a little over 2/3 of the portfolio is actively managed. And within that, we break down buckets of thought in terms of how we select our stocks. From the left side of this chart, you'll see what we would call the athletes, the ones that have repeated success, repeated consistent success. They are your growth and income, largely dividend payers, if not exclusively dividend payers, but not just dividend payers, companies that increase their dividends, increase their rewards to shareholders through cash returns on a regular basis. So a company like PNC that has a 3.6% yield, which is nearly double the overall S&P, but is also growing that at a 7% annual clip over the last 5 years. If you look at Microsoft is now in there. It doesn't pay the largest dividend, but it grows at a 10% clip. And from my standpoint, having been doing this now in my 31st year, seeing names like Microsoft and Apple in the dividend payer and growth and income category is certainly interesting. In the middle column, you have cyclical growth. When we say cyclical growth, you think about cycles. You think about what the economy is rewarding in the moment. And right now, the areas that are being rewarded in the moment are energy and financials, as well as healthcare, and I'll talk about that in a little bit as well. So you see a name like Goldman Sachs that is not just earning or performing well, but is growing their earnings by 12% a year, and actually has a relatively low price to earnings ratio at 14, when 20 is close to 20 is the benchmark at this point for the market. Or a name like JP Morgan, which is similarly in there. Energy represented by Chevron. We can determine our reasons why. And then probably our favorite, if we had an all-star stock selection chart, Corning would be on there. We purchased Corning now 3 years ago when it was a little-known glass screen manufacturer for iPhones, and then the data center thing hit. We have well into the hundreds of % return on Corning. That's been a fantastic name for us to hold. If you've ever been to Corning, New York, it's a beautiful place. Again, it's the type of name that we own in the cyclical group because again, the cycle of data center build-outs is certainly benefiting a name like Corning. And then on the right, you have what have been more of the highlight of the market for the last number of years, the high growth, primarily tech, but those that aren't necessarily interested in paying a dividend, they're interested in plowing their earnings back into the growth of their business and growing as quickly as possible. So in here you have names like Palo Alto Networks, and in my individual trading business, I tell my clients one thing: it is no matter what happens in the economy, no business is going to back off of their cybersecurity spend. That's one thing that I guarantee you nobody is going to lighten up on. So it may not be Palo Alto, it is right now, but cybersecurity is one thing that nobody can afford to go, that's where we need to cut costs. So we see very high growth in areas such as that. GE Vernova, again, centered around the AI build out, providing energy and services to data centers. Taiwan Semiconductor, growing at 15% continually per year, has been a very strong growth. So that's how we look at things. We want to have a diversified basket between growth and income, those that are taking advantage of the cycle, so the foundation, the cycles, and then the high growers, and create a mix. And depending on what the market is providing in terms of opportunity, you'll see the weights of these categories shift. So kind of like one of those water sand things that you tilt up and down, and you see the water move. If more reward is being found in the growth and income category, then you'll see that list longer. It's just for the last number of years, the higher growth names have been the ones that have been rewarded, so we've had more names and more representation. On page 23 is the current individual equity holdings, and this is where I'll come back to.
I'm sorry, I'm new to all this meeting, I apologize.
Absolutely. I love
I've got
questions.
a question here. The ones that like AstraZeneca that's only producing 2%, can you move the money to a better one that's performing better, or do you just leave it in that kind of fund?
So that's a great question. What you're seeing here is justification, not return, right?
Okay.
So as we're looking at the different evaluations, different companies like an AstraZeneca, which have performed very well,
Okay.
this is so our breakdown. Now, some of the categories, something like, again, an AstraZeneca, the three categories of stocks that have done best so far this year and are not tech, they are energy, healthcare, particularly bio-healthcare, and financials. Those three have done really well. So Astra benefits from being in that, obviously one of those
Okay.
categories,
Yes.
and these are the justifications of that. So yes, part of the reason for being actively managed is we're not beholden to an index, that we're evaluating each company and each holding on its own merits.
Okay.
And if there are other opportunities, then yes, we certainly
Okay.
do move to other names. We don't own the entire sector.
Okay,
Does
thank
that
you.
answer your question?
Yes,
Okay.
thank you.
So again, on page 23, the top 10 individual equity holdings. When I was referencing the targets or the rules of the IPS, this is exactly what I was talking about. We have three names that have eclipsed the 5% cap and are in the process of being reallocated. It's pruning trees, right? You prune them so they can grow back. It's a good problem to have. We didn't start at that 5%. NVIDIA is another one we've owned for a very long time. We keep trimming it back and it just keeps growing. Apple, which if I were to pick one that I was going to own to the exclusion of all others, Apple continues to push forward and break the cap. And Apple had actually surpassed NVIDIA in overall market leadership for a few days last week, and then Alphabet, which is Google, is in that category as well. They keep growing. We keep needing to trim them back and reallocate those resources. One of the things that I point out here a lot is that technology is such a broad category that everything's technology. In fact, I tell you, if you really wanted to, I could tell you Eli Lilly is a technology company. AbbVie's a technology company. They're all tech companies. I think the tech category is going to go away, and they'll be absorbed in other categories, because if you lose your iPhone, nobody's going, that was a luxury item. You're going out and replacing your phone, and that's as consumer staple as it gets. So I think we'll see that in the next couple of years. But nonetheless, when you see a number of these percentages, they're actually lower than the overall market. So as high as they are, which is a point that I'll make on page 24 as well, that the sector categories represent exactly where the performance has been. We do not line up right on the sector category percentages for the S&P. This is the first time that I've done a meeting in the last few years where I can tell you that we actually are overweight tech, although the broad tech, not necessarily the narrow band of just AI tech. But we're also, if you remember those three sectors I pointed out, we're also overweight financials, we're also overweight healthcare, and we're also overweight energy. So the diversification of the portfolio is designed to take advantage of where the opportunities are. Some of those percentages are a reflection of the performance. Again, if a sector does really well and grows, then it's going to skew the percentages a little bit. But again, we're not looking to take big sector bets. Sometimes the names do it for us. On page 25 is the passive strategy performance. And roughly 32% of the overall equity, not the overall portfolio, but the overall equity sleeve is in passive ETFs. So you have ironically, the growth ETF is up 5% year to date. The value ETF is up 22% year to date. So remember what I keep coming back to thematically today. It's not the Mag 7. It's the incredible 493, not the Mag 7, that have really done the work so far this year. So the value is actually outperforming. Now, part of that is, if you've heard of the name Micron, Micron started the year, they make chips, as a value stock. Well, Micron's up 300% year to date. I mean, chips took off. So things like that skew indices, and that's why you diversify. The Russell is 2,000. The small cap index is similarly up 22.5% year to date. The small caps have done exceptionally well, and international is up 13. And one of the reasons we use international ETFs is we don't have an office. Well, we do have an office in South Africa, but we don't have an international equity. So sticking to our knitting will allow the ETF to fill that space for us. On the bond side, our mandate is to stay investment grade or better, BBB or better. We also are positioned, bless you, we're also positioned where the yield value is. There's not a lot of benefit of going out past the 5-year mark at this stage, although we can see that changing with the 10-year hitting 4.9 this morning before pulling back a little bit. I would not be at all surprised if our bond team isn't looking to take some additional duration and move out a little bit farther on the yield curve and capture some of those yields. But right now, most of the value is in that 3-year range, and so that's where you see most of your weight. Bonds typically in a portfolio are there for balance and ballast. They aren't there to drive returns, but to provide a steadying influence on a portfolio as you're doing semi-regular distributions. We want to make sure that we are dampening volatility to whatever degree we can. That's the primary role of the bonds through both their stable pricing as well as the income they pay into the portfolio. It's like laying a foundational base layer on the portfolio. So I will take a breath and a sip there before I get into the overall economic and market outlook. Are there any additional questions on the portfolio? Testament to my thoroughness. So, on page 28 is U.S. GDP, gross domestic product. It has come down a little bit. We're now growing at 1.5%. I would expect we'll probably see somewhere in that same range when the next print comes out as well. The strength of the U.S. economy when it comes to continuing GDP is that the American consumer consumes and the United States government spends. Those two things both add to GDP. I don't see, for better or worse, any of them going away anytime soon. So we continue to see that. The other primary driver is fixed investment. Companies like Alphabet, Meta, and the like are spending the entirety of their free cash flow in the next couple of years on data center build out. And yeah, I agree with you. But it is, you know, they are pushing and even doing debt financing to some degree, or equity, like Alphabet, I keep wanting to say Google, issued new shares of stock to raise additional money in order to do that. So you're going to continue to see business fixed investment drive. So whatever shortcomings the overall economy has, consuming government spending and CapEx is not likely to go away anytime soon.
Isn't that a bubble?
Well, it's only a bubble if there's no demand on the other side. And the demand, the token demand for the data centers has far outstripped and continues to far outstrip what is being built. So at some point you will hit a saturation. But unlike the internet build out where they were just laying fiber as far as the eye can see on the hopes that somebody would want it on the other end, right now it's 180 degrees the other. There isn't enough token capacity to fulfill current demand, nor is there enough on the back end of that. Excuse me, in terms of the cycle. At some point you'll hit saturation, but that doesn't. There's no sign of that at this point. The continued spend by business on AI is it's not like anything that we've ever seen before.
But that's that's artificially inflated numbers by the companies themselves, not by the actual demand. They're testing and they're making a product, but they're not really, the demand for that product is not as high as people are saying.
No, statistically and spend-wise, all of the businesses from Ford, GM, Caterpillar, Mariner, JP Morgan, all of them, the demand from businesses for tokens is outstripping their ability and their capacity to generate the compute. It isn't just from their own individual demand. S&P profit margins are high and continue to climb. Again, part of the underpinnings of the overall cycles we look at as we look at returns. PEs, the price to earnings, have actually compressed, not expanded. The reason being that within a PE, it's a calculation. You have the price divided by the E, and the E continues to increase, and so it continues to cut into the PE. So we've seen very stable PE as we move forward, and the margins continue to expand. It's a different it's a different argument, but you look at different business models, and the reason why we see economic cycles that don't look the same as they did 20 years ago. Recessions were largely defined by physical inventories that were too high that needed to be drawn back down, and you had actual physical things like tires sitting on on cars that weren't going to be built, and that all had to be processed through. It's not the same type of inventory when you're talking about how much does another Google search cost, how much does another unit increment of something, a service cost. It's a little bit of a different animal. So you're looking at a profit margin cycle that continues to push forward and push up. Inflation concerns are an interesting one, and I could give you an hour here, but I won't. But one of the areas that we look at, and has long been one of my themes as an economist, is that we talk about inflation as this one unitary number when it's not. My inflation rate is not your inflation rate. Now, you used to be able to look at it and say the inflation rate of somebody in their 30s isn't the same as the inflation rate of somebody in their 60s, because somebody in their 60s has health care, which is more expensive than buying a new TV. Now you can look at it even more granularly and say, if I use myself as an example, I don't pay dining out costs because I have a farm and everything I eat comes off of my farm. So my eggs are, are simply the cost of my inputs. We own our home. if you're renting, although that's another thing, rents are actually coming down, that you're paying more to rent, you're paying more to dine out, and you're paying more for different things like auto insurance has come back down. Right now, the one slider in there that impacts everybody is energy. You can see in this chart that the lime green of energy has popped back up in the last few months, which is the primary reason why we've seen the inflation numbers cycle back up. Energy is a little tricky to calculate from an inflation because it's a double count, because energy is in everything that you do, right? I'm telling everyone who probably knows that energy is in everything that you do, as well as a product in and of itself that gets measured, so it's a little bit of a double count. But there's no question that costs have gone up. Whether that's actually inflationary or not matters only in what the policy prescription is, not in the fact that people are paying more because energy's high. So as we look at what the Fed might do, and that's coming up here in a couple of charts, I don't actually like the titling of that slide. I don't expect the Fed to do a whole lot. We'll talk about that here in a couple of slides. Labor market has weakened slightly. Again, labor market right now is a tricky one to actually pin down. With all of the work this administration has done in terms of deportations that have truly impacted the labor market. Our labor market statistics are noisy. Real wages, particularly in the lower quintiles, are growing at a significantly faster rate than they are at the higher quintiles, 5.5% to 1.5% right now. So that isn't the sign of a weakening labor market. I think what you're seeing is numbers in terms of raw numbers of people being employed is a very noisy statistic right now. So we don't really have a great grasp on who is working and who isn't working and who's available to work and who's not. But regardless, if we look at an unemployment rate of 4.2%, that's historically is a very tight labor market. So whether it's the tightest it's ever been or just historically fairly tight, it isn't an unhealthy labor market at this stage. And on page 32, consumer spending continues to spend. So there's a lot of talk about what's known as the K-shaped economy, where the rich are doing great and the non-rich are going the opposite direction. Statistically, that's not accurate. There's no doubt that there's a wealth gap separation, but an actual income gap separation, it isn't an E. It's more everything has risen up. And anecdotally, if you've flown recently, if you've tried to go to an IMAX movie, if you've tried to have any particular type of experience, you'll see lines wrapped around the door. That can't all be one narrow cohort. So if we're looking at where consumer spending is, consumer spending continues to be strong and getting stronger. Bank data tells us that debt levels, primarily things like credit card levels, are actually shrinking, so it isn't on the backs of debt. Charge-offs are falling, meaning that bad debt isn't accumulating, it's actually going down. So the overall income picture across the entire economic spectrum has improved, even as it doesn't feel like it. And the consumption numbers bear that out. So as we look at what matters in terms of what we're doing here, we look at where we're investing money. We have to evaluate whether or not there's going to be a consumer on the other end of that iPhone, or there's going to be a consumer on the other end of that Netflix subscription. We don't have Netflix, but using as an example, that Netflix subscription, and that spend still continues to be there. Here's the slide I was referencing. Page 33, the Fed has been lowering rates. Well, not anymore. We don't see them lowering rates. We also don't see them raising rates. Raising rates is not going to bring down the price of oil. And you're only going to add to and add to the risk of a potential contraction, because then you're choking off credit. And one thing that we have learned through various cycles is that the quickest way to cause an economic problem is to constrict credit. And so, again, while we are likely no longer in a lowering cycle with prices where they are now, I don't suspect we're going to see Fed rate increases anytime soon either. So where we are is where we're likely to be until we see some kind of systemic change. Oh, look, a credit slide. Credit spreads remain historically tight. This is true. A credit spread is the difference between what a non-investment grade bond is yielding and an investment grade bond. When those spreads widen, that tells you that the investment market feels like there is significant risk of default, so they're going to require a non-investment grade issuer to pay a significantly higher yield because of that default risk. When everybody seems to be doing really well, then those spreads narrow because there's very low risk of default. And what this is telling us is right now there is the understanding that there is a very low risk of default across whether it's investment grade or non-investment grade, which also tells from our standpoint, why would we buy a high yield bond when we're getting the same yield for an investment grade bond? So we're in good shape there. Consumer confidence and equity returns. Well, the best time to buy stocks is when people think it's an awful time to buy stocks. And right now, for a confluence of reasons, the negativity surrounding the overall economy, the political environment being an election year, you can add any number of reasons. It is a fairly dour mood, and that is historically a great time to buy stocks. So we're looking at right now a sub 60 consumer confidence number when the historic average is right around 78. So that's historically a very good time to buy stocks. And just as we do with the three buckets in evaluating the overall economy and individual stocks between the growth and income cyclical and high growth, we do the same thing in terms of evaluating the overall economic environment, fundamentals, valuations, and technicals. We won't, as we typically don't go through every single one of these categories, but we rank everything in the fundamental category, the valuation category, and the technical category as either positive, neutral, negative, or a combination neutral, positive, neutral, negative. Fundamentals are looking at things like, from an economic standpoint, inflation, earnings trends, interest rates, credit spreads, the fundamentals that make up the overall economy. And right now, what we're seeing, is almost exclusively positive to neutral positive, with the outlier of inflation, which, as I explained, I'm not sure I would classify as inflation, but nonetheless, it does impact the economy. Valuation, meaning how expensive or cheap things are. We have everything as neutral to potentially neutral, negative. And then the technicals, which we use as a confirmation signal for our purchases and decisions. We look at fundamentals, back them up with valuations, and then we use technicals as kind of a final check. And right now, the technicals all point to either neutral, neutral, positive. So in summary, if we were to look at that, as we are, I would say, more than cautiously optimistic at this stage. Not full-throated let's go. There are some flags, there are some concerns certainly. The situation in Iran has real impact here, as it has impact on energy, and energy again is a double count in life as well as in statistics. That matters. So it isn't full sails ahead, but nonetheless, as earnings continue to grow and outperform continuously across the spectrum on all sectors. All five, nearly not all 500 names, but all 11 sectors of the equity market, then it's been a good time, and we expect it to continue to be a good time to invest. Our beginning of the year target, baseline target for the year was 7,700 on the S&P. We've exceeded that, but since you don't get to lock that in, we don't know where we'll finish. So we may well exceed that, or we may fall behind it. We'll wait to see. But what we do know on page 37, we will always include this chart, that it does not matter what the end year is, because the vast majority of end year numbers are positive, significantly positive. 35 out of the last 46 years, you've had positive year returns, but despite that, the average intra-year drop each year is 14%. So we expect volatility. It's more normal than not. We expect to have pullbacks. We've had a near correction this year. We certainly had a near more than correction last year, down 20% intraday, 19 on close. So it happens. But we're looking through that. We're looking to long term. We're using that framework in order to build out an overall portfolio. We have, per your request, continued to include each individual holding. If anybody ever has any questions about any of the work product here, any of the analysis, or any of the individual holdings, I'm available to answer questions now, although I probably couldn't do you granular on each individual holding on the spot, some of them. But please feel free to contact me, email, anything, and we'll get you an answer as to the whys and hows of how we're doing things. So with that, again, I'm happy to answer any questions, and thank you so much for having us again.
All right, thank you. Moving on to our next agenda item, any old business? Any new business?
Is there any way we can get just a cost of what it actually costs us to run the pension, how much we're paying out per quarter? And if possible, what we are, I mean, obviously, getting what we're paying in, we get a rough estimate.
Yeah.
You don't know until really end of year, usually. So I would just love to know how much it's costing per quarter. That way we can just get a better idea of what, you're throwing a bunch of wonderful numbers at us, but what's that versus what we're paying out?
Yeah, I mean, you have I don't have it with me, but you each quarter receive an individual statement on the cost.
No, I'm not just the cost of you, but what it costs for us to pay to the people receiving pensions, stuff like that.
Oh,
I
yeah.
have that.
Yeah, is there any way we can have that entered into the record as well, so we at least know what, we know the money coming in, I would love to know the money going out as well.
I have to redact some of the information, like the account number and some of that, since it's a public document, but I can do the costs and things like that.
The cost, obviously we don't want all the, I'd really not like to get hacked, but I would like to know I'd like to know what it's costing us versus what we're bringing in as well. Just to get a better idea, so if we need to make adjustments, or at the very least, I can walk in knowing we are having a good year or a bad year, but what's the baseline cost for all of it?
Isn't some of it on this?
Well, the net flows are there, but if you're looking for specifically what is
Yeah, this
the
would be more
outflow.
her department, because
Yeah.
she's the one managing it.
Yeah.
So I would just like that information out there, just so I know if I need to feel uncomfortable or comfortable.
And the union office does get a copy of the bank statement each month, so if that's something that you were interested in, you can talk to Laura about that, but I can give you the numbers that you're looking for.
I would love it to be in the record as well, just so everyone knows.
Like I said, I'm new at this. I've got a question about post-retirement question. Can I bring that up now, or?
Miss,
Jody has it. Jody, did you have something you wanted to say?
You are muted, sir.
Okay, I was just gonna say that last year during 2025, we had income contributions and all not investment, of about 940,000. And the pensions and the refunds that went out were about 840,000. So in 2025, we actually had a net inflow for the year. And 2024, 23 and 24 were slightly negative. There were slightly outflows instead of inflows. So really the income outflow for the plan is pretty balanced. There's not a lot going out. And in fact, in 2025, more came in than went out, if that helps.
It does, it's just something I would like to have on hand at all, every time we do these. Just, again, just to have an idea of how things are going.
Thank you, sir.
Yes, so, I asked Nikki, I don't know, 6, 7 months ago, that question about so, at 62, I'll have 35 years in if I'm still here, and I'm not married, which I'm good looking, I might be married before the end. But anyway, what I'm saying is, if I retire at 35 years, and I start drawing my pension, and God forbid, I pass away 2 weeks later, all the money that I invested for all those years goes back in the pension. I just was wondering if we could do something to make that better, because that's a lot of stress. You know?
Yeah, currently the plan has only a spousal benefit, so that would be something that the pension committee would have to.
I'm not asking for the money Lextran put in, I'm just asking for what I put in. You know, see what I'm saying? Maybe if you don't draw your pension for 3 years, you know, something, just something where you can sleep a little bit better at night. You know, because there's a lot of people that are not married, you know, and might could be in the same shape that I am, you know? That's what my question was. Thank you.
Thank you.
Is there a way we could add maybe a child benefit? Spouse and or child, like you designate an heir, I want to say heir, but that's not.
Beneficiary.
Thank you very much. It's been a while since I've done insurance. Beneficiary, so. Instead of just spouse, it's still the half, but it's half.
Something.
Is there a way we can amend the,
We can have, when Steve does the next actuary report, he can run those numbers, because that will change the whole outlook of the whole plan. But we can add that to the next actuarial report.
Thank you.
Anything else? All right. Next scheduled meeting for the pension committee will be November 10th, 2026. We don't have any questions. Meeting is adjourned. Thank you, everybody.
Thank y'all.
Thank you, Jody.
Thank you.
Thank you.
I'm not gonna skip my